Currently, the stock markets have become so volatile that no one really is able to predict and even give you the advice of whether you should actually buy, sell, or hold a particular position or a particular stock. So, what are the strategies of certain personalities who have actually earned crores of rupees, have multiplied their wealth in so many years? What would be the methodology that you can pick up from them? What you can actually learn from these people is what we are going to discuss in this video of Commerce Gyan today. So, how can you actually be a good stock market investor? We have heard certain names, like if you see, the first name is Rakesh Jhunjhunwala. So he was considered to be as one of the most famous personalities who became rich by investing in the stock market. So he was often called as the big bull. He was a CA, a son of an income tax officer. He started off his stock market journey by investing just 5,000 rupees and went on to make it into a 41,000 crore of net worth by the end of this era. Another famous personality was Radhakrishnan Damani, who was considered as the wealthiest stock market investor, and also he is the founder of DMart. The next name is Ramesh Damani, who has invested in the stock market when the Sensex was just 600 points. Of his first primary investments was Infosys. Now, what was so important about this person was that in the following in that particular time frame when Infosys was nothing, he understood the potential of this particular company and said, okay, I'm going to put my money in this company because this company will give me good returns. Now, how did he understand that Infosys would become a big company ahead, and what was the analysis that he did? This is what will be understood by you also by the end of this particular video. What strategies do these investors actually use? Coming to the next name, if you see, Ramdev Agarwal, who is the founder of Motilal Oswal Group, in the last 30 years, he has followed certain strategies, which is the primary key strategy of the stock market investment. And that is nothing but the best earnings of the stock exchange always happen in long term holding positions. Short term holding positions, traders who rush, who pick a buy, sell trade in that particular stock rarely gain a huge amount as a net amount by the end of 10 years. Take the total of your own trading portfolios. If you have done trading in the past 10-15 years, how much did you really gain? And look at the portfolio of a person who is a long term investor who held a stock for that time duration. So certain stocks may have given you the returns, huge returns, but at the same time, there are certain stocks which you may have lost a lot of money in trading, and the net of position, the net of returns has come to meager maybe 10 or 12%. Then what's the point in investing in a stock exchange, right? What is the point in investing in shares if you can't get a substantial amount? Share trading is not something which will give you a huge amount of returns, as most of the market, if you see, is controlled by the huge players. They manipulate the market, short term market specifically, for their specific advantage. This is reality because the major shareholding is with certain companies, with certain investors, and so with their buying or selling, the market can go upward or downward depending on that position. So for a retail investor, for a person who is investing in the stock market, individual investor, for him the best strategy would be long term investment. For this purpose of long term investment, what you need to understand are these key factors. What you need to do is stock selection. Certain shares need to be selected. There are around 5,000 shares in the market, and you cannot really buy everything, right? So you need to choose, make a choice, and how to choose the stock from those 5,000 shares which are listed out on the stock exchange. These are the strategies which can help you. The first thing that we need to understand before going to the strategy is, why do we invest, right? Why do we put money in the stock market? Second is, what is exactly meant by this term of stock selection? Third is important thing which we need to understand is the types of analysis that are followed in the stock selection process. And finally, if we are talking of financial ratios that are used in stock selection, we are going to discuss those ratios which are used in analytical part, the analysis of stock selection. The first important thing when we talk of why do we invest, why do we put money in the stock exchange, we have different options, right? We have options like fixed deposit, we have options like PPF. Then why do we turn towards the stock exchange? The most important reason is return potential. We know there is a huge potential of gaining better returns than in a stock exchange than a fixed deposit can give you. So if a fixed deposit is giving you 6%, there is no point in putting your money in a stock exchange and getting just 6 or 7%, because you're putting the money in a riskier investment and getting less amount or the same amount as the FDs. So what you need to know is that if you're selecting a particular stock, it should have a good return potential. At the same time, you cannot completely compromise on safety. Like if we see certain companies which give huge returns, but at the same time, if your money is blocked, it is gone, right? Because the company has such volatile position. And finally, most importantly, is liquidity. If I need money for a certain purpose, I should be able to get it back quickly. So shares of good companies often are very beneficially held in terms of liquidity. So if we just talk about Infosys, Tata's or such shares, so these are just examples to quote so that you understand that if you go to buy or sell these shares, it is easily got, right? If you plan to sell the shares of such companies, easily the liquidity is happening, easily you get the money in your hands. So for return purpose, you need, very important is these three things: return potential, safety and liquidity. Now, important thing in stock selection, the second important part that we need to understand is that what is my investment objective? Am I investing in the stock market for the purpose of maybe 5 years down the line, I need money for a certain purpose, maybe the education of my child, or it could be the purpose that I need to construct a house. Whatever the objective is of investment should be very clear. How much is the duration that you are prepared to put money in? That means I don't want to liquefy my money for the next 5 years, 10 years, 20 years, whatever. So you should be very clear on this. Then next step is to check on the stocks. Check on those companies, the shares of the companies which give you or meet up with your objectives. And finally, what we need to understand, as I told you in the beginning, that you have a huge number of shares, 5,000 plus shares which are listed on the stock exchange, and it's not possible for you to actually buy everything with the budget that you have. And so you need to make a choice, and this is where stock selection is coming up and helping you. So what is the analysis that is generally used in stock selection? Now, important analysis techniques are listed out here. First important thing is economic analysis. Second is what we call as fundamental analysis, and third is what we call as the technical analysis. We are going to discuss in elaboration on each of these things. The first thing that we talk of is the economic analysis. Now, what is this economic analysis? Now, we often talk of terms like GDP, income, per capita income, the industries which are going into as sick units, industries which are growing. There is a huge potential of a particular sector, FMCG sector, for example. There are rate cuts, like the GST rate has been cut by the government. There are benefits given to certain companies. So different things are happening around us, and this comes up in the news. Remember, stocks get influenced by the news, stocks get influenced by sentiments, and how to tap these sentiments is in your economic analysis. So if you're good at economic analysis, you can actually be a good investor in the stock exchange, because you know the right time when you have to put in the money and the right time when you have to withdraw the money. Second type of analysis is what we call as the fundamental analysis. Fundamental analysis is connected to the company, purely to the company data. So what data does the company share with you? It shares with you the financial statements. That means a public limited company, specifically if it is listed on the stock exchange, has to disclose its financial statements and certain important key events key things about the managerial persons, about directors, about funds where they are going to be invested, about orders they are going to receive. All these fundamental things will be given by the company to the investor. So in the fundamental analysis, you have two parts of the data that is available from the company's side. One is your qualitative analysis. Now, this is nothing connected to the balance sheet or the financial statements of the company. What is this qualitative analysis? Suppose a key managerial person resigns from the job, resigns from his position in the company. Do you think it impacts the company operations? Definitely yes. So, is it actually that you can calculate how much the impact will be? The answer is no, not exactly. So, basically, qualitative analysis is talking about the company key persons, decisions that are taken by key persons and so on, which are not having an exact quantitative statement, or exact number crunching cannot be done here. So this qualitative analysis also helps you, because if a person from a key managerial person from a company is resigning, and maybe he is followed by another 2 3 key personals who are resigning from the same company, it may indicate a certain problematic area in the company, and for long term survival this company may not be good if the key persons are resigning. So you have to study this qualitative analysis, qualitative understanding of the company, why these people resigned. Were they replaced by better people? Was it something which was like a fraudulent activity which was sensed by these people, because of this they resigned? Whatever the case may be. So qualitative analysis gives you again the sentimental side of that company operations. It also helps you understand how these things, how the decisions can be influential on the financials of that company. The second type of fundamental analysis is the quantitative analysis. Now, this is something connected to number crunching. It is connected to calculations based on the financial statements that have been provided. Now, what do you exactly see in the financial statements? Now, must see factor is obviously the revenue, the income. How much is the company earning? Now, always remember, if you study the balance sheets of a company, you don't study it for 1 year. You will naturally see the growth of the company, the revenue growth of the company for maybe in the last 4 or 5 years. So this is a very important thing. Every kind of analysis which you're doing in fundamental analysis should be done for a long term, at least 3 years period for the company. Then you will also look at net profits of the company. Income is there, but there is no profit. Not good. Return on equity. How much are you getting against the investment? So, are you getting any dividends from that company? Is a company a good company giving dividends over long term? Then, what is the future growth potential of the company? So, is it having orders in hand that will give you an idea of more revenue generation, more profit generation, right? And finally, you will be looking at the financial ratios. So you will look at certain key financial ratios, at least, which will give you an idea of how you study the balance sheet of the company to understand the long term position of that company. So, what are the key financial ratios that you need to take into account? The first financial ratio is the price earnings ratio. What is this price earnings ratio? It is a very widely used ratio in the fundamental analysis of the company. Now, price and earnings. The computation says what is the price per share. So, basically, when you're buying a share, you're going to pay something for that company. If you're buying it in a maybe an IPO, you pay certain amount, let's say 300 rupees per share. If you're buying it directly from the secondary market, that is the stock exchange, you pay, let's say, 380 rupees. So this amount is something which is connected to the price per share. So how much is the price, the amount of the share that has been paid? Second part of this ratio, the denominator, states the earnings per share. So, how much is the amount of profit available per share to the shareholder? So, this determines whether the company is giving you profits, and if it is giving the profits, what is the amount of profit available for each shareholder against the amount that they are paying. So, if I am paying 100 rupees, And if I am getting, let's say the earnings are only 5 rupees, that means for each 1 rupee of earnings, I'm going to invest 100 rupees in that company. So let's see the calculation for two examples here. Price per share is given as 100 and 200. That means in on the stock exchange, you pay either 100, or on some other day when the price increases, you are paying 200. In that same year span, I'm assuming. So earnings per share, which is computed from your profit and loss statement, which is given in the financial statements of that company, the profit is said to give the shareholder 20 rupees per share, right? Earnings per share in one example is 20. In the next example, also we are taking it 20. So basically, in that 1 year's duration, company is, it has the potential of making the payment of 20 rupees as dividend to the shareholder. So what will be the price earnings ratio? In the first case, it will be 5. In the second case, it will be 10. Which one is better now? How do you understand? In fact, if you look at certain newspapers, certain key analysis statements which are given in the case of every stock exchange data or company data, you will often find PE ratio, P oblique E ratio given. So it is ready-made given to you. Now your job is to understand this ratio, how it works. So if the PE ratio is less, that means if you see the first example, you're paying 100 rupees and you're getting 20 rupees. Okay. So in this case, ratio is 5. So if you're a long-term investor, you are in a good position because you're paying less for the share which is giving you 20 rupees. If you're paying 200, that means you're putting in more money into a company which is not giving you the amount of profits in the right proportion. So the lower the ratio, the lower the PE ratio, better it is for long-term investors. For short-term trade, it may be different. But in the normal situations, a lower PE ratio could give you a brighter, a better potential for long-term investments. So remember this. So comparative PE ratio can be studied for different years. Second type of the financial ratio that is generally used is the price to book value ratio. So market price or current price of the stock versus what is disclosed in the financial statements as the book value of the stock. Now, normally a low ratio of price to book value would decide and would say that the stock is undervalued. So let's see an example for understanding this. If you see price to book value ratio, current stock price that you're paying is 100 and 200, we assume. Book value per share, we are assuming 10 and 10. Okay. Now the ratio for the first example becomes 10, second example becomes 20. 10 is the ratio. So book value per share is 10 and the current price of stock is 100. So what does this show? So the lower this particular ratio, it shows that your stock is undervalued. The third ratio is what we call as the return on equity, ROE. This is also a very important ratio as an investor for long term because it tells me that how much am I putting in as investment against what the company can give me as returns. So dividends, basically, if we take into consideration dividends, and basically the better the dividend ability, better the profit earning of the company, most of the time the stock price also matches to this particular better potential of the company in the long run. Computed. This is basically computed by two parts. One is where you're talking of net income, and second we are talking of average equity. So we are going to see how much is the profit that is got against equity. So if a fixed deposit is giving me 6% returns, how much is the share giving me? Net income, that means returns that I'm getting on the investment, maybe, let's say, if we take this example, maybe 1 lakh rupees. This is the net income of that company, 1 lakh, 1 lakh. And average equity, average on the shares that are there in the company are 1000 and 2000. So ratio in the first case is 100 and second case is 50. What is the first ratio stating? That for every single share that you're buying, you are going to get 100 rupees as the profit. So when the number of shares increases, obviously automatically the profit per share will reduce. So if you are having a lower ratio, it is not a good sign. The higher ratio shows that you have that the company has the potential of giving you a better part of the income against the investment that you're making. Then, in the case of another financial ratio which needs to be studied well is the debt equity ratio. Two things of the company. One is how much is the loans that the company has, borrowings, external borrowings. And second is how much is the equity. Equity means the owner's fund. So, what we are trying to see, if you see, let's say your friend has maybe a house which is worth 10 lakh rupees and you are wanting to give a loan to that person, what would you study? You will say the friend is having a house of 10 lakh rupees. Loan against that particular property is taken as 9 lakh rupees, let's suppose. Now, when the friend asks you for a loan, would you be prepared to give a loan of 20 lakhs? The answer would be no. You would say tomorrow, if you sell off the property, you get 10 lakhs. Out of this, you're going to give back 9 lakh rupees because you have a loan. So, what is your net worth? Your net worth is only 1 lakh rupees. So, this is what the debt equity ratio helps you understand. Debt equity ratio tells you how much are the borrowings against the own fund. So, own fund is nothing but the owner's fund, the equity fund that is there in the company along with the distributable reserves. So if any profit was accumulated and kept aside, this amount is clubbed in the equity, right? So basically your loans and your owner's fund, we are matching, calculating a ratio, and this ratio should not normally exceed 1. Even in case of banks, when they're lending, they take 2 is to 1 also as the ideal ratio, no problem. But as an investor, if you see this ratio exceeding 1, that means it is a clear sign that the company is borrowing more than what the owners are putting in money. So just imagine, in the normal situation, a person, if he puts 1 rupee and somebody else puts in 10 rupees, will he work hard? The answer would be, normal cases would be no. He may say, okay, it's not my money. Why should I work so hard, right? So, as it is, the company is formed on the basis of somebody else's money. So, it may not work well. So, unless and until owners put in their own money, they will not work to the extent that is expected. This is what is the general understanding, and this is what the general common sense tells us, right? So here debt equity ratio is to be calculated. We can see with examples. If the ratio in the first case is zero point 0.5 or half, let's say, and second case it is 1, both of these show us a good position of the company. Let's see, if this ratio was 2, then also it is fine. But if it exceeds, like it is 5, 6, 10, then it is a position to worry, because the loans are more than what the owners have put in. And tomorrow the owners may say, I just quit, company goes into liquidation, and you may be in trouble. Now, coming to the final fifth ratio which we need to consider is the current ratio. What is this current ratio? It is telling you about the short term liquidity position of the company. The earlier debt equity ratio told you of the long term liquidity. That means tomorrow, if the company is liquidated, how much the owners have invested, how much the outsiders have invested, correct? In the case of current ratio, which is also a very important ratio in fundamental analysis, is the study of current assets and current liabilities, like short term assets, short term liabilities, to make it simple. Now, what is this short term? Short term is 1 year. So if you have to get money from somebody within 1 year, it comes under current asset. And if you have to give money to somebody within 1 year's time span, it comes under current liabilities. Assets which get liquidated within 1 year's time duration, like suppose I have sold goods and the money is to come, debtors are there, it becomes current asset. If I have to pay for the purchases which I've made within the next 3 months, it becomes current liabilities. So this is how the current assets and current liabilities are taken into consideration, and a ratio is calculated by dividing the current assets by the current liabilities. Now, on in a general circumstance, this ratio definitely should exceed 1, because the amount of receivables should exceed the amount of payables. In your own case also, you think of it. If I have to pay some money to somebody and if I have to get some money from somewhere, obviously money I get should exceed the money I have to give. So if you keep this in mind, the same thing applies to a company. Company is going to get money in the form of current assets, and I have to give money out of this. The company has to give money out of this in the form of payables, which is the current liabilities. So if I get 100 and the liability is 90, it's fine. But if I have 100 and the liability is 200, it is bad. Correct? So this is how the short-term liquidity position of the company can be analyzed. Companies may take risk and take more borrowings for the short run, but they don't have the money to repay. And this in turn goes into a problem area in the long term. So short term problems then trickle down into long term, and long term problems may lead to liquidation of the company, which is harmful for you as an investor. So for the long run, continuous study of the current ratio is important. If the current ratio is good, company is good. These are simple two examples where I've taken two ratios computed. In the first case, the ratio is 2 is to 1, and in the second case, it is 1 is to 1. Both are good because your receivables, your current assets are more than your current liabilities. So these were the things in fundamental analysis. Now the next part, which is also used as an investor for the stock exchange analysis, is technical analysis. And this is what is most often spoken on most of the news channels. That what is the technical analysis? Basically, we are studying the stock exchange. We are studying the performance of that particular share on the stock exchange. We are not talking of company data, the balance sheet, the profit, the revenues, the payables, the receivables. We are not talking of that. What are we talking of here in technical analysis, which most people in the short term are very keen to understand? We are talking about whether that stock price gone up, gone down, whether it is stable, whether you can buy today, whether you can sell today. All this is taken into consideration. Now, whole focus is on the stock market and the share price that is going up and down in the stock market. Here, predictions are made of the price movements of the stock, right? Of that particular share on the stock market. How the predictions are done on the basis of historical data. How this data worked in the past. So 5 years back, whether that stock performed well, whether it will go and perform well in the next 5 years, how is it? So this is done with the help of different charts. This is done with the help of certain graphs and charts, generally like the line diagram, line graphs. You can have the candlestick format, you can have the bar graphs format, and so on. So different varieties of, you can say, technical analysis exist in the market, but this is generally beneficial for short-term traders. And at the same time, if you're a long-term investor and you want to make good money, technical analysis helps you if you see historical data of the last 3 to 4 years. So where the stock price had the dip, whether it takes a dip every 5 years, whether it takes a dip every 2 years, every 6 months, this can help you understand when to buy. Whether the stock goes up to a certain level every 2 years, this is the place where you can actually exit. After 2 years, you can think of selling it off. Like this, the technical analysis can help you in understanding the position, when to enter that particular market, when to exit. But at the same time, if you want to be those types, like if you want to understand whether the stock gives me a long term benefit or not, the fundamental analysis is equally important. So as a long term investor, you can use these things, these techniques, for the purpose of investing in the correct stocks of specific companies which can be useful to you. And most importantly, remember these few things also before you go and invest. The first important thing is that no stock is best at all times. You cannot say this particular stock is reliable since the last 50 years, 30 years, 20 years. No. You have to do an analysis and review of your portfolio every now and then. And this review of your portfolio, if done Generally, 5 years at least you need to review your portfolio. Then obviously you need to seek advice from financial experts when choosing portfolios. If you don't have the correct judgment of when to enter into a particular stock and exit from a particular stock, it can harm your portfolio. It can harm the profits that you earn on that stock. So these are the key important things that can help you to be a long-term investor and get good returns on the stock investment that you would be doing. So hope these tips help you. And if you like the tips that I've given you, do press the like button also share it with people who may find it useful. So just in case you have not subscribed to this channel of Commerce Gyan, do subscribe. We will be giving you insights into financial knowledge, economics, different subjects of commerce, law, and any recent amendments that the government has made in different sectors connected to commerce. So hope to see you in the next video of Commerce Gyan. Thank you.